Are you taking some profit now when it comes to Kweichow Moutai? You've got the likes of Jefferies. They've raised their price target for this stock by 36%. Is that overdoing it?
Yeah, thanks for having me. So we expect Moutai to report a good first half that would be in line with management guidance of 10% revenue growth for the year. We expect also that third quarter is usually a seasonally strong quarter where consumers tend to make purchases for the Golden Week and the Mid-Autumn Festival. So the risk to the story is unrealistic expectations built in by the street and the buy side in order to justify its valuation re-rating this year. So while the valuation is not cheap, we do not think that it is particularly egregious. The market is giving a premium for companies that are able to deliver earnings with certainty, especially with the virus cases in China flaring up again. So we have slightly reduced our position to move our money to sectors where valuations are more attractive, though we still like Moutai as a core holding in the portfolio.
Do you think they'll be able to raise prices in the second half?
I think the expectation is there. They usually raise prices at the end of the year. And I think that at this point, we really have to see what the political situation in China is. It's particularly sensitive if the economy is not doing well and they raise prices, so we have to see. But I think the market is expecting a price hike probably at the end of the year or next year.
And Wei Wei, I know you like the infrastructure play here in China as well. You've got holdings like Sany Heavy. What are valuations looking like in infrastructure? Are they still looking attractive, or are you seeing that rotation now?
Yeah, I think the infrastructure names are still interesting and relatively fairly valued versus the rest of the consumer staple space. So we have severe flooding in South China, so some of the investments and infra projects have been delayed. We expect the flooding to release pent-up demand over the next few months. And our checks with industry experts recently indicate second half should remain pretty robust, and they are generally constructive for demand outlook into 2021. So we think that the demand strength for construction machinery stocks in particular is not only a function of the government support on infra investment, but it's also driven by new factors such as labor substitution, stricter safety and emission regulations, and also an increased focus on efficiency.
Wei Wei, it's Rishaad in Hong Kong. Tell me, do the numbers, the earnings so far, corroborate those amazing figures that we had in terms of industrial profits? Does it back that up?
I think so far what we've seen for the industrial space, there's recovery, there's cyclical recovery for some particular sectors, and we've seen that the supply side has been pretty strong. Like I previously mentioned, the floods will cause some delay in some of the projects, but so far, for the stocks that we have, Sany Heavy, Jiangsu Hengli, Dingli, they've all so far reported good numbers, and we're seeing good traction over the last few months.
Well, tell me something else, Wei Wei. We've got this growing, it's saber rattling going on between Beijing and indeed Washington. How is that affecting your outlook? Are investors shrugging that off in large part?
I think we are focused on mostly the domestic market in China. The portfolio is skewed towards companies that play on import substitution and localization. So I think we're watching this closely, but at the same time, we have minimal exposure to export-related names. So I think we're still pretty comfortable with our positioning right now.
And Wei Wei, how much exposure do you want to have to Hong Kong stocks at this point?
In terms of direct Hong Kong-related names, it would be just Hong Kong Exchange. I think Hong Kong, like I previously mentioned before, we're still in a tough situation with the virus and the unrest last year. So I would still focus on names listed in Hong Kong that have exposure to the mainland market. I think that is the way to go. And then we will have more listings from the U.S. market coming back to Hong Kong, and this should give a boost to the Hong Kong Exchange.
Wait, what about divvying up these stocks as well? Is this the time now to be moving away from growth into more value-laden stocks here as well? And what about state-owned enterprises? How do you invest in those? Do you invest in those or stay clear?
Right. I think it's natural for some rotation to occur, given the huge discrepancy in performance between growth and value so far. However, we continue to be positive on growth for three reasons. First, we think the economy will find it hard to have a sustained recovery without a vaccine, and investors will flock back to companies with higher earnings visibility and pay a premium. Secondly, we think that the information age is materially different to the industrial age, so capital requirements are becoming less intensive. And with most new economy business models, they have unconstrained capacity compared to the industrial age. So these companies have technically infinite scalability, and the market will also assign a lower valuation to surplus capital that we have now. And then finally, the quality of the so-called value sectors in China, which are mostly SOEs, are lower than their peers in the US. So these companies typically have to engage in a lot of national service, and this comes at the expense to minority shareholders.